Okay, so we're setting ourselves up today for a much excited and much needed conversation with Dan Leverington, who's the MD of Ocelli Group, and myself, Paula Kensington, as you probably know me if you're watching this, as CFO and also host of CFO Conversations. So both of us have got many, many different hats, but today is really a conversation that has sustainability at its heart. But what does that mean for the CFO? Maybe other C-suite executives that are watching this, what does it mean now? And what can we do about it? What's holding us back as CFOs, maybe even board directors, what's holding us back? So I really wanted to have a really casual conversation where we can just touch on our different aspects, our different areas of expertise and experience. You know, I've been a CFO and still a CFO for the past 25 years. And, you know, I've been in boardrooms. I know what goes on behind closed doors. And a lot of that was why I left corporate because there was a whole load of bullshit going on behind closed doors. But anyway, I do know what goes on in the boardroom and I know how challenging the role of CFO is. So I think mandated climate reporting and sustainability reporting and all of that that's coming over the next 3 to 5 years is the biggest change in 25 years. You know, we look at the world of accounting and reporting, you know, and IFRS made its big, big change where it actually brought the globe together and made us being able to sort of compare like for like from a business perspective. And that was 2001. That's like 25 years ago. I mean, geez, it makes you feel old. So I guess maybe where we start is what's keeping up the CFO at night? Like what's the issue? And I'm actually going to start with taking a step back and saying mandated climate reporting isn't even on the CFO's radar. A lot of CFOs out there. Yeah. I mean, maybe group ones obviously are in it, but I don't know what the numbers are, but I would say 80%, maybe more of CFOs globally aren't even thinking, haven't got the headspace yet to worry about climate reporting.
Yeah, I would say that that is accurate, and it's interesting because just because they're not doesn't mean they shouldn't.
Yeah. And there's a lot of people that are finding this very frustrating, myself included, saying, where's the CFO? Come on, guys and girls. Like, we've got to get with it. Like, because now it's here. And I guess people are thinking, oh, well, you know, it's being rolled in over the next 3 years. I've got time. But if anyone's actually unpacked what actually has to happen, you would actually be kept awake at night because it's a huge amount of effort and work, and not just in finance, obviously, but across the whole business, across the whole value chain, across the whole supply chain. This really is a once in a 25-year event.
Yeah, yeah, I'd agree, and it's the the ask or the need that CFOs are going to have to step into is becoming more confident, not just with the financial data, but also the non-financial data.
Mm,
And the things that have traditionally been seen as externalities sitting off the balance sheet are now being brought in-house.
mm.
And they're starting to have to figure out what do we actually do to mitigate these risks, but also to embrace the opportunities
Yeah,
that are going to present themselves as well.
yeah,
And particularly from a group two and group three perspective, generally the first time they're hearing about this is when a customer asks them for it.
mm, yeah. Or yeah, that's right, a contract or an RFP or something like that. Like you
Yeah,
said before, the conversation that you and I have had, you're saying that some of the chief sales directors are coming out saying we need to do something because
yeah,
it's in my RFP and we've got no information.
totally. And there's such a flow-on effect from not having that information. You don't win the tender. If you don't win the tender, the revenue targets aren't hit. The individual sales head of sales don't hit their targets. They don't get their bonuses. They end up getting pretty upset. So there's all these knock-on effects that are not directly tied to emissions tracking or your waste management policy or your water management policy. But that can genuinely harm the business in the short to medium term.
Yeah. Well, I've been talking to a CFO that I'm coaching at the moment here in Australia, and he gave me six big rocks on the strategy for the next, 1 to 3 years. Sustainability and climate reporting is not on that big rock list. It should be, and it will be because they're a group two entity. But how? So this is what's keeping the CFO awake at night. There's contract negotiations on either investment or divestment. There's, manufacturing strategies. There's JV strategies. There's whole, how do we think about the product strategies? And so when he says that, I go, yeah, okay, I get it. But actually, climate and sustainability has to feed into all of those big rocks,
Yeah.
but just
I mean,
not kind of seeing it.
it was interesting as you were going through that list. I was like, yeah, it's involved in that and that and that.
Yeah.
The the investment conversations are only going to get more difficult for companies
Mm,
that don't prioritize their reporting. And then it's going to become something that if you get the reputation as a company that isn't taking this seriously, it's going to become harder and harder to
mm,
find investors.
mm,
The manufacturing perspective, if you're thinking about manufacturing strategies and you're not thinking about how renewables plays a role in that, you're automatically locking in an energy premium
mm,
because you're going to be paying for a more expensive source of energy. From a product perspective, if you're not thinking about how can you embed circular economy principles to reduce the amount of waste in each of your products, you're automatically setting yourself up for a headache in the next 3 to 5 years as your customers, either on the B2B or the B2C side, start questioning
mm.
what is going into this product that I'm buying.
Yeah.
So I think initially when the mandatory climate reporting was announced, there was it was almost a mindset of, well, it's just another tick box exercise, and so we'll give it to the compliance team, and then we'll be able to put it into the annual report saying that we've ticked the boxes.
Hmm.
And like you said, like this is such a seismic shift in the expectations on executives and boards. Like, but
Hmm.
boards are personally liable, so they're going to be very motivated to make sure that their executive teams are focused on this. But the way that that is playing out means that the CFO is going to have to play a greater leadership role
Mm.
in this transition because everyone's looking to them for guidance,
Yeah.
and a lot of the time that guidance isn't there.
Yeah. And it kind of then begs the question, well, what's holding the CFO back? And I think number one has to be almost the vagueness of it all. It's like there's this thing that is like, best efforts to build these narratives, and it's not kind of quantitative per se initially. So
Hmm.
I think there is a lot of vagueness around like what's required and how we're going to get there. And I think that's stopping the CFO from actually being able to action. Because we're very much give me a list of what I need to do, give me the compliance of what I need to do, and I'll do it. But even if you look at the Australian reporting standards and the IWSB, there's still kind of a little bit, it's still a little bit kind of wishy-washy. And
Yeah.
it's like, if you can't, if trying to do this work is going to, I can't remember the language, but create uncertainty for the reader, then you can not do it. But I think, well, if how do you know whether something's got more certainty than not if you haven't actually done the work? It's kind of
Uh,
like you're going to have to do the work anyway to show the auditor that you've done the work, to say
yeah.
that actually now you know that by reporting this, it's going to be too confusing, or it's going to give you an impact that it shouldn't with your audience. So there's just, I don't know, as I say, you start getting into it and it's just huge.
It is. And the ASIC's approach has been one of, or their stated approach has been, we're going to take a pragmatic approach and we're going to work with organizations to uplift
Mm,
capacity and capability. Um, but they're not, anecdotally, they're not providing too many get out of jail cards at the moment. I've only heard of one case actually.
Right. Right.
And so the the hope that I think some CFOs are living on at the moment that this won't be a big deal and they'll be able to skate through unnoticed, I
Mm,
think will be pretty unfounded.
mm.
Because I imagine ASIC will start from a pragmatic perspective, and then after a couple of years, we'll move to enforcement pretty quickly.
Yeah. Yeah. And I don't even think it will be a couple of years. I think it will have to start making examples of where companies haven't got it right to ensure that people realize that there's actually a regulator with teeth. And it's
Sure.
not just, oh, well, I'm going to get a slap on the wrist. I
Yeah.
mean, back in the day when I was in ASX world, no one wanted a qualified audit report. It was like you would do absolutely everything you could to ensure that you didn't get a qualified audit report because that would give you going concern issues and share price issues and everything else that comes with that.
Yeah.
Um, and and yet now I don't think the penny's dropped because there's limited assurance in the first year or two. I think was it 2030 where the intern or the auditor association has said, oh, we're going to give reasonable assurance by 2030, which is like, wow, okay, take your time, 5 years. But I think we're going to get there a lot quicker. I think
Definitely.
the auditors are going to say, well, how am I going to put the words in the audit report that says, we're not comfortable with what you've done? And
Mm.
I think it's going to start to filter through that, some companies aren't doing what they need to do.
Yeah, and I think that's the risk of focusing on a compliance first
Mm,
approach. If you're purely thinking we're just going to do the bare minimum that we're asking,
mm,
there's a lot of your competitors who are not taking that approach and they're
yeah.
seeing the market opportunity. And so, looking at this through the two risk profiles, one being physical risk, the other one being transition risk. Transition risk, if you don't take this seriously, someone's going to eat your lunch.
Mm.
Um, and we always talk about the Kodaks, the blockbusters of the world. That is absolutely going to happen over the next few years to a firm that thought that they didn't have to take this seriously,
Yeah.
and then they find out that they've been disrupted by competitors who did. The other piece is the physical risk. Like, look, I think one of the biggest misnomers in the reporting is, well, we're just going to plant some trees and we're going to be compliant,
Mm.
which is absolutely not the case. But what the reporting helps organizations do is actually have a look at what are the environmental changes going to have an impact on their business and how is that going to look? And so if you're looking at a physical risk perspective and you're looking at what flood impact could look like, what bushfire impact could look like, what drought could look like. On the border of southeast Queensland and northern New South Wales. We had tropical cyclone Alfred came through earlier in the year. That was considered a non-event,
Mm.
and yet the insurance companies still dealt with $1.5 billion worth of claims.
Mhm.
So, like for a non-event to be responsible for $1.5 billion worth of claims, there's so many knock-on effects through the supply chain
Mm.
that if you prepare for them, you can deal with them. But if you're trying to figure it out in real time, you're automatically coming from behind the eight ball.
Yeah.
And I don't, like, speaking of pennies not dropping, I don't think that piece has dropped yet. And any CFO who isn't taking this seriously, I would venture, hasn't yet conducted their climate scenario
Mhm.
analyses
Mhm.
because that is one of the most sobering exercises I've
Yeah.
seen companies go through as they start looking into, the medium to long term.
Yeah, for sure. And I think my gut feeling is that when businesses look at that from a chaotic transition at 3 degrees warming, like they won't have a sustainable business. I mean,
Yeah,
I do what kind of lands for me is once the CFO's done that piece of work and maybe shared it with the board, I'm guessing, like you can't not see that anymore. It's like
totally.
what's the obligation then to say we haven't got a sustainable business?
Yeah,
And you can't tell me that in a 3 degrees warming world that we've got business as usual.
yeah,
Absolutely not. So what's going to happen with that? I mean,
yeah.
we
Agree. I mean,
haven't
like,
even gotten there yet.
yeah, like the 3 degrees, we don't have a a normally functioning society. Two
No.
degrees, and we're already kind of
Oh,
on
well, I
on
think we're there,
the
aren't we?
yeah. Well, yeah, I think we're just under at the moment. But the thing is, like, if we do hit that, but then the decarbonisation pathways kick in, we can
Yeah.
absolutely bring it down. Um, my hunch is, and this is where I think the CFOs that are doing a really good job, and I think this is why they're doing a good job. Firstly, there's a genuine sense of curiosity,
Mm,
and they want to know more. Um, but secondly, I think I think they can understand without their CFO hat on,
mm,
the impact that this could have on not only their family, but the employees, the local community that the
mhm,
business serves.
mhm,
And like Christiana Figueres, who pulled together the Paris Agreement, she speaks about the importance um, of selfish self-enlightenment.
mm,
So realizing that this is directly going to impact me, and I need to do everything possible in order to not be impacted negatively. And I think where the companies that are moving, they can see how it's going to impact them on the personal level, but then also the professional level, and they can see where the investment money's going, either to the companies who are seeking investment or the energy transition. So over $2 trillion was invested into the global renewable energy market last year. Like people aren't doing that for charity.
no.
And there's a really interesting interview a couple of weeks ago where they were talking about if we reversed things, if we had started with renewable energy and someone came along and said, I've got this great new technology, it's called coal and oil and gas. It's going to be a little bit more expensive. It's probably going to damage the environment, and there's going to be global shortages of it.
Mm,
There is no way that we'd make that transition.
mm,
And so now that we have the opportunity to be working in the time frame and the timeline that we are working in, I think there's a huge opportunity for CFOs to look at the commercial benefits of dropping your cost of production by getting access to renewable energy, not being exposed to the global volatility that are leading to oil prices shooting up and down, and thinking about how do we actually ensure that we have a defendable business model that
mm.
is sustainable even if we do increase from a global temperature perspective in the short to medium term.
Yeah. Yeah, and that goes back to thinking about our supply chain. Like that is a competitive advantage where we're
Yeah.
not just looking at the business that we have, but all the businesses that are in our supply chain. If we have a complex supply chain, then what about all of those businesses? Because, the failure of those and also the exposure that they're causing, lands on us because they're in our supply chain,
Yeah. And
Um,
it's a fascinating point because so generally, obviously each company, individual company is unique to themselves, but generally, the supply chain makes up about 80 to 95% of a
mm,
company's total emissions. So
mm,
that the internal emissions, so your scope ones for running your business, the scope two emissions from generated from or from the generation of electricity, that they make up 10 to 15%.
mm,
But the majority is in your supply chain.
mm,
But that also means that the majority of the risk is in your supply chain. And so working with those suppliers who are already being asked for this information from their other customers
mm,
is really important
mm,
from a risk mitigation perspective. But it also means that you can start seeing a lot of efficiencies that can be found
mm.
so that potentially they can drop their prices because their cost base is going. So all of a sudden, that your procurement function isn't just looking for the cheapest price possible,
Mm,
it's looking for the best value for the company if you're taking into account the whole picture and not just focusing on a particular cell in a spreadsheet.
yeah. So I think some of the other challenge, I think, is, short-term versus long-term thinking. And this is for, the executive team, it's for, the leadership in the business, where it's like, well, it's not going to happen. It doesn't matter on my watch, which kind of worries me. And I have seen some executives, namely the CEO, where that you get what you reward. The behavior you get is what you reward. And if you're not rewarding the right behavior when it comes to climate, then you're just going to get more of the same. And so in the legislation, there is requirements around remuneration reports and how are they linked to climate action. Um, and I think there's a very small number of businesses that have actually done that. It'll be interesting to see what happens at the end of 2026. But the businesses I talk to, there's no climate metrics attached to my STI or my, package.
Yeah,
So, so I feel like you're still getting the same behavior because, a lot of people are driven by financial reward,
definitely.
and unless you actually hold someone to account by holding back their money, then potentially, you're not always going to get the right kind of behavior.
Definitely. And I think this is where having the mandatory climate reporting set up under Chapter 2M of the Corporations Act and putting that personal liability on directors, I think we're going to start seeing that change pretty quickly because as a part of the reporting, you need to break down your report into governance, strategy, risk management, metrics, and targets. The governance piece is how are you setting up the governance of your organization? What are the committees that are being set up in order to drive this? And then, as a part of that, the KPIs and bonus structures are coming out of that. Because you're totally right. If it is very difficult to find examples in corporations where people are doing tasks that they're not being paid for.
Yeah,
Like
totally.
it's the reason why incentives exist. And so
Totally.
that top-down incentive structure will absolutely be coming in.
Yeah. Yeah. And I think also with the short, long-term thinking, this scope three that we know is a huge impact on our business is not coming in the first wave of reporting. So it's
Mm,
almost like, well, don't worry about scope three. It's like, no, 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 we have to.
yeah,
And
definitely.
it's almost like, well, don't just because, you and I know, and I'm sure a lot of other listeners know that getting ready internally for this is going to take 12 to 18 months at least.
Yeah,
So, if you're group two, then, you've got to get started now before the 1st of July 2026 because, that's when you start reporting. Um, I think a lot of people are waiting and seeing what happens from group one, and it's kind of a fallacy because you're just going to be, like you said earlier, behind the eight ball when it comes to actually being able to understand what's in scope three, what's in our supply chain. Now, I don't have a strong manufacturing background, but I know from some of my roles that it was like, well, if one of our key suppliers, you know, fails, puts prices up, becomes someone that isn't someone we want to deal with, oh well, we'll just find another alternative. But
yeah,
I wonder that kind of thinking is out of date because we've actually now got to not work against our competitors, but yeah, we've got to be more collaborative with the businesses that we're working with, and that means our supply chain. I
yeah,
think often people have said, well, you're lucky to have a contract with me, so you've got to kind of be the servant and I'm the master. And I just think that kind of thinking is just really out of date.
totally. And I was fortunate enough to be on a call on Tuesday that was looking at supply chain networks across Asia.
Mm,
And the first thing that I took away from it was we are falling so far behind in Australia. There were representatives from companies across six of the largest economies in Asia, all talking about the integrated supply chain, all talking about the environmental product development that they're doing in order to maximize uh, their customer retention
mm,
because their customers are asking for this. Now, some of their customers are some of the largest companies in the world, so there's a lot of motivation for them to
Mm.
maintain that. But they
Mm.
were saying it's not just coming from them. It's genuinely coming across their entire customer base because they understand how important it is to have a clean scope 3 profile for
Mm.
investors and insurers. And I think insurers in particular seem to be the ones that are forgotten about the
Right.
most, but they are the ones that are going to ratchet up the premiums because they're the ones, climate scenario analysis for them is something that they do every day.
Yeah,
Like
and they've been doing for the last probably 20 years,
totally.
longer.
Absolutely. Like Munich Re, I think they just published their 50th anniversary of their first natural catastrophe report. So like they've been doing this for a long, long, long time. And so companies that are just stepping into this for the first time, there's an asymmetry in terms of knowledge.
Mm.
And we know that the insurance market enjoys an asymmetry of knowledge, right? That generally means they can have a higher premium.
Mhm.
And so if companies are coming to those conversations with nothing to show of what they've been doing so far,
Yeah,
that cannot end positively from a commercial perspective.
no.
Um, and the other piece from that call that I took away was exactly what you spoke about. The collaborative nature of those supply chains, both vertically and horizontally, is
Mm.
really impressive. And
Mhm.
they're not all trying to reinvent the wheel at the same time. They're
No.
actually leaning on each other to figure out, well, you're really good at that, and we're really good at this.
Mhm.
Um, and I think Australia, if we play our cards right, we will have a really strong opportunity over
Mm.
the next, 5 to 15 years to embed that across the economy, to ensure that we have so many things going for us,
Mm.
right at the moment, but we're only a quarter of the way through the century. So yeah, there's still a fair way to go.
And I think we've talked about this as well before around risk registers and insurance renewals. And, I think back 20 years when I was sitting in a boardroom with our insurance broker and looking at our risk register, which was probably only about, I don't know, 50 long. And with that lens of, show me the controls that you're putting in place to mitigate this risk. And it felt like we were just doing that exercise for the insurance renewal and we weren't doing it. It was like, oh, thank God we've done that. We've gotten through, the renewal. And then it's like, oh, well, back to normal. So,
Yeah.
yeah, but what I think is now being regulated is that control mitigation understanding of climate scenarios and risks and what that reward is and what that the risk and the reward are is actually should be part of our business as usual, not something we do for renewal and trying to impress the broker or whoever it is.
Yeah, it's that's a really good way of putting it. The um the finance function and CFOs in particular, I think the reason why they play such an important role in this is because these standards were effectively written for them.
Mm.
These came out of 2008, post GFC, wanting to, like the International Accounting Board, wanting to have a clear understanding of where are the major global economic risks hiding.
Mm.
And that was the direction that they were given. And climate change was identified in that process
Mm.
as an existential threat to the global economy. And so it's been written purely for finance, investors, and accountants in mind. That's why there's so much crossover with business language. I think sometimes when I speak with CFOs, I kind of get the sense they think that like the hippies have finally taken over the boardroom, and it's not the case.
Yeah.
Like this is purely focused on ensuring that as much risk can be mitigated as possible for all stakeholders involved, and that stakeholder pool is now getting very large, and they're all requesting the same thing. So you've got your investors, your insurers, you've
Mm.
got your regulators now from the government, you've got your customers. You've got your
Mm.
employees, you've got your local community. Like,
Mm.
it's at such a point that it's going to be very difficult for companies to not head in this direction because it's in their own self-interest.
Yeah, and that pool of stakeholders becomes bigger and bigger because you haven't even mentioned nature there. And
Totally.
this is like TNFD,
Yeah.
which is like I don't even want to freak CFOs out there. I haven't even thought about that yet. But this wave of standards, whether or not you believe that countries around the world are rolling back, pulling back on things, like it doesn't matter.
Mm.
Like, this is a climate that actually we need to protect and ensure that we don't go above 2 degrees. So we've
Yeah.
got to do the work. So it doesn't really matter what governments say or do and pull back. Um, but, I think, oh, where was I going there? We've got to do this work irrespective of what the climate, what the governing regulators are saying. But, the increased velocity, if you like, of standards now. So we've got this standard, and then we're going to sort of think about sustainability more generally after climate, and then we're going to have nature's disclosures around biodiversity, and then we're going to have impact. Like, there's a whole realm of impact accounting that I've
Yeah.
been watching and being involved in, which now has gone fed underneath Capitals Coalition based out of Europe. But that's on the trajectory for the next 5 to 10 years that we're going to
Mm.
have to actually think about what impacts we're having on our surroundings, let
Yeah.
alone people and nature and everything else. So, it's going to be a huge avalanche of regulation now over the next decade.
For sure. And I mean, it's interesting because I'd love to hear your thoughts with your CFO hat on. The incentives that are in place from a government perspective, from a financial institutions perspective, are pretty significant. Like, are there many other options or examples you can think of where if someone came to you and said, "Hey, I can get you 1 to 2% less on your
Mm.
loan if you do this behavior,"
Mm.
that CFOs would look at and be like,
Yeah. Yeah. I don't know whether everyone has got exposure to that, has even been seen where the greeniums are in terms of funding. I mean, I'm kind of involved in funding that isn't kind of what can I call it? Old finance market type funding. It's like, I'm getting involved in um, new concepts around landscape bonds and regenerative finance instruments, which is a whole nother chapter. But, and I think so the commercial CFO wants to know, is my $10 million loan with top four bank, what's it going to cost me, and can it be renewed? Like,
yeah,
I think that's the issue. If we're not demonstrating the right behavior and measuring climate, even if we're a non-reporting entity, privately owned, we've still got a $10 million facility with a top four bank. We've got to have confidence that that's renewable. And I think some banks are saying, well, if you can't demonstrate that you're got this reporting, the transparency of what you're doing, then either we're not going to renew your loan or it's going to go up two
yeah.
basis points or whatever it is.
Yeah, for sure. But then the opposite is also true. Like there's enough products, like financial products now on the market for if you do want to start switching to renewables, if you do want
Mm,
to
mm,
start implementing some of the changes that are going to reduce your impact as a business, they will reward you for doing that. And I
mm,
don't know if that's a case, there's definitely companies that are taking that up. But the ones that aren't, I can't tell whether that's a case of they just don't know that that option is available to them,
mm,
or they don't believe that the savings justifies
mm.
the action.
Yeah, yeah. And I think again, it goes back to short-term, long-term thinking. I think, you know, there's been so many examples where it's like, well, the business case doesn't stack up because, the cost outweighs the benefit in the short term. I mean, in my view, if we're not investing in the right products, you know, the decarbonisation strategies, if we're not investing in all of that, then we've put all our revenue at risk. So I can't imagine how that would outweigh all of the revenue at risk. I mean, it maybe there is an investment that's required in the first year, and
Mm.
then it's going to pay back in years 5 to 10 or 10 to 20. I mean, I've not been a CFO in a business that we've gone beyond a 10-year time horizon. I mean, maybe all CFOs now go beyond a 10-year time horizon as standard.
Yeah, I mean, the climate scenario analysis requires them to, at least from a climate perspective. But I
Mm,
mean, it's fascinating because we're now starting to see so many business use cases of companies that made the decision when the short-term cost was high,
mm,
but the long-term ROI has been significantly more, like Walmart, right? Like largest retailer in America.
mm,
So 20 years ago, they from like 20 years ago they started basically pasting every section of rooftop that they owned in solar.
right.
And yes, like I'm sure they put out a press release saying that that they believed about the planet, but really it was a cost
Mm,
it was a cost saving exercise.
mm, mm,
Now, as energy prices in the States skyrocket, they're laughing
mm.
because not only do they get
A
to
new
point to their
income stream.
customers, totally, they've got a whole new income stream. They can say to their customers, "Look how much we care about the planet."
Mm,
They can say to their investors and their people, "Look how much profit we've generated." And
mm,
then they can look at their competitors who didn't install solar, whose prices are going through the roof, whose products are therefore getting more expensive to cover that delta.
mm.
And all of a sudden, it is the classic triple bottom line. We've come out ahead because we were an early mover. And
Yes.
and I think examples like that show you're not going to be punished by the markets for
Mm,
making this move.
yeah. 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 Okay. So where to from here?
Uh, I I always think the best place to start is to get a bunch of people in the room that don't often sit in the same room. So, like, whether that's as at an exec or senior management team perspective, you want to get your procurement people in. If you've got a sustainability person, I would be speaking to them regularly.
Mm,
You want to get a read on your CEO in
mhm,
terms of like how is this sitting with them? How do they think the company should be playing this? Because they're going to have to front
mhm,
at some point. They're going to have to front a lot of questions about it. But then figuring out with your board, like,
mm.
is this important to you? Is personal liability under Chapter 2M important to you? If so, like what do we need to do? And then as we mentioned, like if you're a CFO and you haven't spoken to your sales team in a while about what they're seeing in their tenders, I think you'd be pretty surprised at how often this is coming up.
Yeah.
And I always say to my larger clients who have, pretty significant and complex supply chains, the onus is on you to be speaking to your suppliers
Mm,
because if they hear it from you, it's kind of annoying
mm,
if you're the only one asking them about it. But
mm.
if within 3 months they hear from five of their six largest customers the same thing, that's
Yeah.
a market trend. And
Yeah.
they will react very, very fast
Yeah.
because that's a business decision. And
Yeah.
so the more that these conversations can take place, the stronger we can all end up being from a commercial perspective and strength of positioning and having that mitigation moat around us so that we don't we can try as much as possible to avoid having to adapt further down the track because that's going to be a lot more complex, a lot more costly,
Yeah.
and yeah, a lot higher risk.
Yeah. I always think you're better off being the driver of your destiny rather than the backseat passenger that's just getting led down
Yeah,
some kind of journey that you've got no control over.
yeah. And also, interestingly enough, I'm sure everyone has good relationships with their peers in the industry.
Mm.
On this, I don't know if I'd be believing everything that your peers are telling you about their lack of action, because I'm seeing enough action to know that some people are
Yeah.
just not
Yeah.
telling the truth publicly. Um, And so don't take what you can visibly see as gospel as to how much is actually going on in the background.
Mm, yeah. Yeah. And I'm having lots of conversations and reach out with CFOs. And some of them have said, like we're good with mandated climate reporting. We've been doing it for a while, and I feel like, we're on a good trajectory, which is great. I heard from another one that said we've just had one of the big four in here, so I'm sure that cost them a few $100,000. But we're good as well. And it's like it is that sort of group two, maybe SME, private business, non-reporting entities that are kind of waiting and seeing. But um, I think there is a lot that we can. I mean, I think we have to empower ourselves to understand what's required. And I talk about there's an MVP. There's like, well, what's the minimum that I could possibly do? And like you said before, under governance, strategy, risk management, and metrics, what is the one thing that I
Yeah,
could do now that's going to start me on that trajectory? And I think, that's the place to start. We've actually got to make a start because we can't improve unless we've made a start.
yeah,
So, like you said before, what committees have we got? What's the audit and risk committee doing?
yeah,
Like you say, what's the CEO's appetite for this? Because if the CEO doesn't think this is important, then, we're going to have to either have a conversation with that person or, that's going to be challenging because I would beg a belief that any CEO that hasn't actually thought that this is important work. And as I said before, we can't have sustainability and climate operating, in a silo. I got a response from one CFO, oh, well, the CRO it has been leading that. I go, okay, that's great. You need to know what your obligations are for signing that sustainability report.
yeah,
You can't just outsource it to the CRO and expect them to understand what your commitments are, what your
no,
obligations are as director or as co-signature on that report.
yeah, agreed. And I think, it's refreshing and important to remember there is not one company in Australia who is doing this perfectly at the moment.
Mm,
The reason why there's such a long lead time into this reporting, or has been, that window's obviously getting a lot shorter day by day,
mm,
but this is because it is such a big shift, because the onus is becoming so much greater on organizations for their own benefit. There's a lot of learning that has to occur across the organization, and learning how to comfortably talk about it, backed
yeah,
up by data, is
that's
really
right.
important.
That's right. And that's the thing, another thing that CFOs I know don't enjoy. If you don't know the subject matter 100%, then you often don't say anything. So that's why sometimes we're getting kind of crickets because if the CFO doesn't know the subject matter back to front, inside out, then they're not going to put their hand up and say, let me lead this. And then, then we're in all sorts of trouble. But, I think empowering ourselves as CFOs to understand what's going on. And I've been working, as you have, been
Mm,
working in this space for like the last 18 months, working out what does the standards say from IWSB and how does that impact Australia. This is like a full-time job to
yeah,
understand what the requirements are, let alone the actual job the CFO has to do.
totally.
So if there's any CFOs watching this or listening to this, we've done a lot of the hard work. We know what the templates are to get
Yeah,
started.
for sure. And where I think it would be very Pollyanna-ish to think that the CFO is just going to clear their schedule so that they can learn climate for 2 weeks straight.
Sure.
But the competing demands that are now coming their way, they've got their day-to-day, and then on top of that, they're getting asked by everyone about AI, cyber, and sustainability.
Mhm.
There's ways to enmesh those three together, but there's also a level of upskilling at the individual level that needs to take place to understand where are the risks and opportunities of that. The final thing I'd say actually is I think the window of boards not knowing how to use AI has closed. So if I was in an executive position, I'd be pretty nervous going into board meetings from now on because I know anecdotally that there is some AI going on to prep questions ahead of board meetings,
Right.
and they're looking for very specific bits of information.
Yeah.
And the ability to placate a board member and say that's not important to us yet, et cetera, et cetera. Particularly when in your annual report you've said to the market that you're going to grow big enough to go up a group in the
Hmm.
mandatory climate reporting.
Hmm.
Yeah, I think there's some real fires that are starting to be lit
Yeah.
in that sense.
Yeah. Okay, all right. Well, I might wrap it up there, Dan. Great conversation. And if anyone wants to hear more or speak to us personally, then I will put links into this video as well. And I'm sure we will get some questions and feedback. So enjoy.
Absolutely. Thanks very much for having me, Paula.